So I am very proud today to be able to introduce to you Mark Heesen, who's our keynote speaker today. We bring you this speaker on behalf of Crossroads Ventures, and it's somebody who I feel really doesn't need a lot of introduction, but custom dictates that we'll give him a bit of introduction, so bear with us as we do so. Back in 1991, Mark applied for the position with the National Venture Capital Association and took the position as the public policy head. He held that position for several years before being catapulted to the president role and held that position for the past 14 years. So in 2 decades, he's been with the leading industry advocacy group for the VC community. He has seen a tremendous amount. We are very honored to be able to bring you him today. In that time, under his leadership, he has seen the industry grow and seen the association grow, both in scope and scale as it relates to public policy agendas, research initiatives, and member programs. He has been constantly engaged in legislative and regulatory issues surrounding information technology, life sciences, clean technology investing, strategic direction for the industry and for the association's professional staff, and managing a board of 26 venture capital practitioners. In his time in the role over the past couple of decades, Mark has been praised for picking his battles and winning them. He has taken on issues such as carried interest taxation, financial services reform, the FDA regulatory approval process, highly skilled immigration initiatives, patent reform, U.S. competitiveness issues, energy reform, and support for basic research funding. To give you a sense of Mark's perspective that he brings to us today, when he first started in this industry, it was only a $5 billion industry with less than 150 members, and only 5% of the investment came from overseas sources. The industry has massively changed. We have the ability today to have him share with us those changes. We expect that he'll be able to identify the trends that he's seen over his time in the industry, as well as what he sees on the horizon. We are hopeful that he'll give us a sense of what kind of continued challenges will face the industry as we look forward. And without further ado, I'd like to bring Mark up to the podium. Mark.
Well, good evening, everybody. It's really nice to be here on and thank you all for coming out on a not very pleasant night here in Connecticut, but happy to be here. I am going to talk about what's happening in the industry, overall, and I'm happy to talk about what's happening from a public policy perspective as well. This first slide shows basically something that shouldn't be surprising to most of you, and that is the venture capital industry is shrinking, and it is shrinking pretty dramatically. What we have seen since basically 1999 is a slow contraction of this industry, and people say, "Oh, that's terrible. You know, we want to fund as many companies as possible. We want to have as many venture capital firms as possible." And I believe that that's actually not true. The valley of death is there, and the valley of death is actually a good thing. So what we saw in 1999 were way too many companies being funded that were Me Too companies. And that year we funded 14 petstore.com types of companies. You can't do that. You can fund 3 or 4, and hopefully one gets acquired, one goes public, and the other 2 nip at the heels and keep those other 2 competitive and moving forward. But 14 was too many. Teenage jewelry websites. We had venture capitalists looking at this, determining, what teenage girls, would see in jewelry. Not your typical venture capital kind of deal, and probably something that we should not have been doing. So I think that the contraction, while it has been severe, is warranted, and the contraction will continue. However, you're also seeing phoenixes rise out of these ashes. I think what you're seeing today is a significant growth in corporate venture capital. And folks will say, you know, who've been in this business a long time, oh, well, they've gotten in and they've gotten out, and that's old news. I think the corporates of today are very different than the corporates of years ago. Corporations don't do much basic R&D in-house anymore, or R&D in general. What you're seeing are many of these corporations understanding that they simply can't buy companies anymore. They have to know what's going on in these entrepreneurial companies very early on in the process. And so you're seeing them dig in much earlier. And simply because a corporation invests in a company today doesn't mean that it's automatically going to buy it. Years ago, if a corporate VC went into a deal, it was assumed that they were going to get bought by that they were going to buy that portfolio company. And if they didn't, that company suddenly had a scarlet letter on it. They're like, oh, if the corporate didn't want to buy it, then it must not be a good company. What you're seeing today are a number of corporates, more than one corporate getting into the same deal. You're seeing corporates take seats as board of directors, not just advisors anymore. You're seeing them be lead investors. You're seeing them go in as sole investors sometimes. And you're seeing, I think, a much better symbiotic relationship between your typical venture capital firm and your corporate venture capitalists. We've seen tremendous growth from an NVCA perspective in the number of corporate venture capitalists as members of ours. About 20% of our membership is now corporate. That's a huge difference than what it was just several years ago. So that's a new area and a growing area of venture. What's also important to note here is that while we still have a lot, while the number of active firms has declined significantly, you're also seeing that some of these active firms have basically downsized pretty dramatically. You know, firms who had gone out and raised $800 million in their last fund, this time are going out and raising a $400 million fund. Those folks who went out and raised a $200 million fund, sometimes many of them are going out and raising a $100 million fund this time. And so, and they're still active, but they've actually moved a bit to investing smaller dollars, and I think that probably will be out fundraising more often. I don't know how long that is going to continue, but certainly something to be aware of as we move forward. So now let's look at investment. What venture capitalists have been doing on the investment side of things. Last quarter was a slow quarter. We invested about $6 billion in emerging growth companies across the United States. A bit lower than we've seen in previous quarters. We still could see a year where, typically right now we're about 24 to 28, 29 billion dollars. We could see that still this year. I think that many venture capitalists, particularly those who have raised a fund, are saying that that's still too high. They'd like to see basically about $20 billion being invested per year. Many people see that as the ideal investment number. I don't think we'll be there, but you saw an interesting trend beginning, and we'll get into this. Much more emphasis on the software side, less emphasis on the clean tech side, and on the life science side. Important for entrepreneurs is that you continue, even with this decline, you continue to see significant numbers of companies being funded for the first time. And first-time fundings are important because it doesn't simply mean, an entrepreneur getting, their first A round. It sometimes means a very serious upscale company that has never taken venture, bootstrapped, took angel investing, was able to move forward without any kind of venture investment, and suddenly is really going to start peaking and suddenly goes out and is an established company and is getting venture. So you still see between 1,000 and 1,300 good companies being funded first time every year. What's important to note, once again, from a Connecticut perspective, is that where we've seen a significant drop is in the life science arena when it comes to first-time fundings. Very significant drop. And this is a real concern for the venture industry, and it should be a concern for all of us who use the healthcare system. You're seeing now, today, the cost of taking a drug to market is so prohibitively expensive, and the regulatory process so long that it's not the venture capitalist, but it's the investors in venture capital firms, our limited partners, who are saying, why are you in this anymore? It's going to take 15 years, and I'm still not going to see anything. I don't want you, venture capital firm, to be investing in life sciences. Or if you're going to be investing in life sciences, it better be later stage, medical devices, or even better healthcare services. And if it can be something that doesn't that need FDA approval, or it need to get a price from the Department of Health and Human Services, that's even better. That's a lot of hurdles. And so you're just seeing less of an interest in the life science area in general. Now, having said that, those firms that have been in life sciences for the last 30 years and have stuck to their knitting over this period didn't suddenly, which some firms did, they were solely life science, and suddenly the internet came in, and suddenly they were in the internet, and then clean tech came along, and suddenly they were clean tech investors. Those who have really stuck to what they know and didn't become huge funds are still getting funded. You're seeing small and medium-sized life science funds, even in this difficult period of fundraising, be able to raise funds because those investors in those firms understand this process, and they understand that these firms really understand not only the technology, but they also understand the FDA process. They also understand the pricing mechanisms. And so, while you're seeing this decline, you're also seeing those venture capitalists who have stayed true to this area, I think, become actually in the catbird seat in dealing in this area, because I think that long term this is a very good area for venture capitalists to be in. Regardless of your politics, one thing that has been very positive from our angle is that the personnel of the FDA has stayed the same. There has not been a change in administration, and the folks that were there over the past 4 years will continue to be there for the next couple of years. They didn't leave even in the interim here. We have found that working with these folks has been much better than we've seen in the past. These are individuals who, by and large, understand the importance of innovation and the importance of innovation to the healthcare system. And while they're not always supportive of what we're doing, they're certainly much more aware and cognizant of the importance of getting innovation into the marketplace than we've seen in a very long time. So there are some positive trends here. Just a couple things to noodle on that came out of our yearbook, which was put together just a couple months ago. a record amount of dollars went into California last year. You hear all the other states say, why would you be in California? The high taxes, you can't live there because the property taxes are so high and buying a house is so high. It doesn't matter. Silicon Valley is there. Silicon Valley will always be there. Entrepreneurs want to be in Silicon Valley. And other states have to just be aware of that. I am always amazed at state legislators all across the country. We want to be the next Silicon Valley. Well, you're not going to be. I mean, just understand that right out loud. You're not going to be. And you shouldn't be thinking that way. They are going to continue to get the lion's share of the dollars. And that's not defeatist. I just think that is where you have to start from a different vantage point as a state legislator or as a governor. What can I do in my jurisdiction? What technologies that we have here are unique? What are the universities putting out here? What's the job base here that's different in other parts of the country? What can we offer entrepreneurs here that you can't offer in other parts of the country? Those things are important. You are talking about fundraising, a couple bullets down there. Those funds that are able to raise money today, some of them can do it very easily. The vast majority can't. But what you're seeing is there is absolutely a have and have-nots mentality. And those firms that have been very successful in the past, limited partners, our investors, are dying to get into them. And that's why you saw 10 of the largest funds basically vacuuming up 48% of all the dollars that were raised last year. And then a huge number of firms being able to basically take over the other 52%. That's very different than we've seen in other years. And I think that the bottom point is very important for entrepreneurs. Though we continue to see an interest in late-stage investing, last year was actually a very good year for seed and early-stage investing, and also for this first-time investing. So entrepreneurs absolutely should not be discouraged while looking for venture capital dollars. Now let's look more closely at what's happening in Connecticut. What's important to note here with these statistics is that our statistics are only as good as what we get. And so if we get good data from states, and some states are very aggressive in having their venture capital firms report, those numbers look better. I don't know what it is like here in the state of Connecticut, but this is the caveat there. Certainly a down quarter. The whole country was down in the first quarter of 2013. Was a bit more than other regions, but pretty consistent investing, and very much like the national picture. The big rise in 99-2000, followed by a significant decline at that point. After that, and then pretty consistent numbers as to the number of deals and investing over the last several years. First-time funding in Connecticut, you had 3 deals in the first quarter, equal to what to the 12 in 2012, but certainly down a bit from previous years. What is interesting here, and I've noticed this in other parts of the country as well that have a heavy life science presence, and that is a number of states that had been heavily skewed to life sciences. Suddenly, you're seeing early stage deals being done in the software space. So you can look at that in a number of different ways. One, there's possibly growing diversification in the region, which is good. Certainly software deals are much cheaper, and so you're able to get into those deals. Or, the other side would be, well, we're just getting out of life sciences, and we're going to start looking at software instead. So who knows where that's going to play out, but this is, Connecticut is not unique in seeing that shift from life sciences over to software. When you look at, by dollars, where the money has gone over the past, what that looks like, eight quarters, I guess, or 7 quarters. 51% is going into life sciences, heavily on the biotech side. 23 into software. What I found actually most interesting here was 16% into the industrial energy sector. We're seeing a pretty sharp decline in that sector right now. However, what you're seeing, the reason you're seeing that decline is that the huge dollars into basically game-changing technologies. Let's fund a new car company. Let's create a new form of energy. Those deals are not being funded right now. But what is being funded right now are things that work around the existing energy paradigm and try to fix it or help it along. So anything to try to fix the energy grid. Things such as better building materials, paint, lighting, those things are being funded right now. Battery technology. You're seeing those types of companies getting funded, like I said, at the expense of what was traditionally very venture capital, and that is we need to go in and basically destroy and create totally new things. What I think we found in the clean tech space is that is extraordinarily expensive, highly regulated, and once again, from an investor perspective, the payoff is so far down the road that many investors are saying, we don't want you venture capitalists in this arena. When you look at it on the flip side, on the number of deals, this is once again showing that while the money is going into biotech and medical devices, only 27% of the deals are in that space, where in the software space, once again, much cheaper to do these types of deals, much faster return, that is taking up that space. And just as an FYI, I see some folks taking notes. These are going to be put on the website, so anyone who wants to look at these in more detail can go to the CVG website and pick these up tomorrow. There is no venture capital without exits, so you always need to talk about what's happening in the exit market. And the exit market has not been great. And you look at this and say, wow, 2012, that looks great, that big red line. You look at that and also say, well, Facebook did a heck of a run. Because that's a lot of what that red line, which is the money part of things, is. As you can see, the count on IPOs was pretty stable from 2011 to 2012, but the payout was a very different in 2012. The IPO market is really quite interesting right now. We've had overall just under 80 IPOs this year. That's across the board. Normally, venture-backed companies make up 1/3 to 1/2 of all IPOs. This year, we've only had about 25 venture-backed IPOs. So there are companies going public, but a lot of them are not venture-backed. You see a lot of REITs going public, you see financial services, other things, but we have yet to see a lot of solid technology companies going public, at least at the numbers. Now, the last couple of weeks we've seen some good, solid IPOs, and my belief is that we have probably the best stable of companies ready to go public than we've had in years. We have a market that has been remarkably stable until the last week here or two. Record highs, great companies, and yet they're still not getting out. And you really have to, think hard as to why that's happening right now. Like I said, I think that we are right on the cusp here of a very good IPO market. What we saw is that a lot of companies pulled back last quarter of last year because of all the issues in Washington. They have not been able to basically beat out some of these other companies that are non-venture backed into the marketplace yet. Hopefully, the second quarter we'll see a lot more venture-backed IPOs. Like I said, it has been a good start to the second quarter, and hopefully that will continue. The acquisition side is extraordinarily important because the vast majority of our companies get acquired. They don't go public. And what's interesting to note is that by number, the number of acquisitions remains pretty constant from year to year. The quality of the acquisitions varies considerably from year to year. Corporations, buyers understand that if the IPO market is shut down, that you're the only game in town, and they're going to wait until these companies are basically begging to be bought until they buy them. What we saw last year is in the first 3 quarters, we saw companies out there buying and buying aggressively. We saw them buying the companies they had to buy, and we saw them buying the companies they wanted to buy. In the 4th quarter, the wheels fell off that bus. Once again, people were thinking about the elections, they were thinking about sequestration, they were thinking about the budget mess, and you saw a lot of companies pull back. We saw a significant decline in not only the number of acquisitions, but also in the quality of acquisitions. And unfortunately, that led into 2013, the first quarter, which was not a great quarter for acquisitions as well. So the exit market, from a first quarter perspective, from both the acquisition side and the IPO side, was not good. But I believe, again, just like the IPO arena, where I think that we could be going into a very positive area, I think the same thing goes on the acquisition side. Corporations are sitting on a huge amount of money right now. They are going to get to the point where they're going to have to start buying again, that they're not going to be able to wait out. And I think that we'll see some better quality acquisitions occurring over the next couple quarters here. This just kind of puts in perspective where this industry has moved over the years from, the IPO being really, really critical to this really being a very skewed acquisitions market. And I think that's part of that was, I think, a couple things. One, I think the entrepreneur, many of them said, I don't want to go public. I have no interest in going public. I think that's changed a little bit. I think the Jobs Act has actually helped in that regard. We're seeing entrepreneurs say, if I can do this confidential filing, maybe at least I'll go out and test the waters and see what's there. Maybe I'll give it a try. You also saw venture capitalists who wanted a return. Saying, maybe, I wouldn't say forcing a company to get acquired, but certainly encouraging a company to get acquired. And so you saw this movement, and then companies that were basically created to be acquired. They could never be a freestanding public company. All of those things have contributed to basically a major imbalance between IPOs and acquisitions, and we would much rather see, instead of a 90-10 split, which we had seen in 2010 and 2011 and 12, much more to like a 70-30 split. This is important to note that this is the first year, 2012 was the first year that we actually gave back to our limited partners more money than we asked them for. Once again, this is not only Facebook, this is a number of other companies, but this is actually very positive news, and it has made LPs happy, and that's why the next several quarters are so critical from an entrepreneur, from a returns perspective. Once you start sending those checks back, LPs are just much more likely to re-up in the next fund. So hopefully we'll continue to see this. A couple things from the legislative front. I think I'm okay on time. Okay. Talked a little bit about the Jobs Act, about the confidential filings provision. I think that the on-ramp for newly public companies has been very helpful. The idea that you don't automatically have to become Sarbanes-Oxley compliant, that if you're an emerging growth company, you have up to 5 years to be fully compliant. That has certainly helped the process. I get a lot of questions about crowdfunding. We did not take a position on the crowdfunding portion of the Jobs Act bill. Basically, what has happened in crowdfunding is what I thought what would happen, and that is the Obama administration, oh yeah, we're in favor of crowdfunding, this is going to be great, it's going to be wonderful for entrepreneurs. Publicly, quietly they were saying, last thing I want on my watch is a old lady in Miami to get screwed by, some crowdfunding platform. So SEC, we know you have to write these rules, but write them really slow and make them really difficult. And that's what we've seen so far. We've seen regulations that were supposed to be out months and months and months ago, still not out. I think that when they finally come out, they will be very onerous and make it very difficult for folks to actually play in this space. Having said that, I think there is absolutely a role for crowdfunding. It's just a question of whether those companies that go down that route were ever going to be venture-backed types of companies. And so I think there is a role for crowdfunding. I think the SEC probably disagrees with that, but I do think that there could be a positive role if given a chance. As many of you know, under Dodd-Frank, the venture capital firms do not have to register. That was a significant win for the venture industry because of the cost and complexity of having to register. And I think that it does make the distinction between venture capital and private equity that much more clear from a regulatory perspective. Taxation, are we going to see major tax reform in 2013? I think it's hard to imagine at this point any type of tax reform. You have a chairman of the Senate Finance Committee who has announced his retirement. You have the chairman of the House Ways and Means Committee who is basically term limited out of his job as chairman. So you have two lame duck chairmen who want to see tax reform done before their watch is done in 2014. And then you have the guys behind them, the chairman-to-be, saying, let's hold off on this because I want the glory. And so you have that dynamic, that internal dynamic, but you also have just the calendar. I think it's very difficult. Here we are in June. They've been talking about fundamental tax reform since the day after the election, and basically we have not seen any real paper on this. And so if it's not done by December, you're into election year in January, and it's hard to see major changes there. Does that mean that you might not see changes in some things? Certainly because of sequestration, you could see proposals up there that, we want to keep the national parks open. So the way we'll do that is we'll use carried interest to pay for that. There could be those types of provisions. Honestly, I don't think even those would pass at this point. So I think it's pretty much status quo from a capital gains perspective, from an individual tax perspective in 2013, and possibly even 2014 at this point. There's a lot of talk of tax reform, but when you take the immigration bill and see how complex that is, and that's not anything compared to the tax code, and they're having major problems with immigration. The wheels are going to fall off that bus many times before it may eventually get to Obama. The press has been way too optimistic on immigration reform from a Washington perspective. I mean, it may pass the Senate, but very different environment in the House right FDA reform, talked a little bit about that, I think that there is a real interest in working with the venture and entrepreneurial community, which we have not seen in the past. And just quickly on, certainly on the internet issue, the events of the last couple of days certainly are going to bring up the whole privacy debate, cyber attacks, all of this stuff is going to be brought up again. I think it's difficult, unfortunately, to see Congress acting until we see a major cyber attack. I think they actually have to react instead of move forward on their own. So it's sad to say that, but I think that's the state of the Congress at this point, and the state of the presidency as well. I can't simply blame the Congress on what's going on in Washington. So with that, please always go to our website. We keep we update. We have a blog that we update constantly. We have our statistics that we put out quarterly, and you can get a lot of information on that. Even from an entrepreneurial perspective, you should be going on here and looking at our model documents. That's the area that's actually hit the most on our website by far. People using our documents as they start negotiations between a venture capitalist and themselves. So with that, I'm happy to open it up to any questions. Sound silence, yes.
Knowing that a lot of the early stage deals, the seed deals and pre-seed deals aren't priced, are those reflected in the numbers in the Money Tree survey, or are those all deals that were priced?
No, you can put in, you can submit that a deal was done and not put a price to it. You can just say that. So it would be in the deals section, but it might not be in the finance.
So convertible debt investments or first-time convertible debt instruments?
No, that wouldn't be considered venture, so that wouldn't be in there. Yes, in fact.
Why haven't we seen more of an impact of the Jobs Act in the number of IPOs over the past year or so?
I think I think it's first that this takes a long time for everything to get through the system. What you have seen is an amazing number of companies who are doing the confidential filing. I mean, you talk to bankers, you talk to others. They are seeing those companies out there now. So that has been a very quick impact. Those companies have not yet given that 21-day period when they say, I'm actually going public. I think a lot of them are basically, they learned on the roadshow that basically they might have to go back and do some work, which was actually a good thing, because then they didn't. And some of them, I think, are just, the bankers are telling them that this is not the right time for a technology company to get to go public. So in that regard, like I said, I think the stable is very good, but we haven't been able to push them out yet.
Mark, I get asked often by business school students at Yale interested in careers in venture capital. There's been a consolidation in the number of firms, half the number of firms now. I see announcements pretty regularly from people in the industry joining other funds.
Right.
There was no track for young VCs at the annual meeting this year, maybe not even last year. What do you see? What should we be telling people that are interested in a career in VC?
I would be telling them they should be looking very strongly at the corp side. We are seeing a lot of employment possibilities in the corporation side, and I'd be telling them that they should actually be an entrepreneur first, because an awful lot of a venture capitalists, if they cut their teeth on the entrepreneur side, are certainly going to be, it's going to be a much easier road for them to hop into the venture side. I do. This is getting on a soapbox, but I do fault a number of business schools who continue to teach these venture capital classes, saying, there's a market out there. There isn't a market out there by and large for the vast majority of them. But they are, they continue to make money off of those courses, and that's not a great thing, in my mind. Yes.
What advice would you give early stage companies looking for seed capital in the venture world?
Well, I think that you have to start looking at angel. I think the angel market has become much more professional in a positive way. That doesn't mean it's been institutionalized. It means, I think, what you're seeing out of the angel space today compared to 10 years ago is that angels are looking at deals and saying, not just is this a cool company, but how do I create this company in such a way, help create this company in such a way that makes it attractive to our venture capitalists down the line. And that's an important element. So looking, and I think the angel community has just become much more sophisticated in looking at deals and dealing with entrepreneurs. So while in the past some people would have said, don't go down the angel route, I think that's actually a very important element for an entrepreneur to look at. I think that entrepreneurs also have to be, particularly in the software space, do I need any of this? I might be able to do this on my own or going through friends and family. And if I can do that, they should do that. And wait until they've actually have something that looks like it can definitely scale, that's going to make a venture capitalist interested in this deal. I think that there's this idea that, you have to go out right away, particularly if you're a software company. You don't. Look around at friends and family before you even go to angels and to the venture community. I think in the life science arena, it is looking, as I said earlier, it's looking at those firms who have stayed in this and understand this area and can sit down with a scientist and cogently discuss what this idea is all about. That's really important. And those firms who are great firms but are not specialized in that area are not the firms, in my view, that they should be looking at. Yeah.
Mark, I heard you when you said we're not going to become Silicon Valley, and I'm willing to concede that. However, I think that there probably are some public policy steps that states can take to try and at least create sufficient venture capital dollars in their own regions to get companies started and growing a little bit. And we've seen that in some places. New York is a great example of a place that's gone from 0 to 60 in a pretty fast.
New York City.
New York City, exactly, not New York State.
Right.
So what are some of the elements that you see that a place like Connecticut can do that could change the number of venture capitalists active here?
Well, the first thing I would say is that you said the government, and I wouldn't necessarily start with the government.
Okay.
I think one of the more successful programs that I've seen in the last 5 years is a program that was done out of Michigan. Basically, when your back's against the wall, like Michigan was, they went to the top corporations in that state and said, we are dying as a state. And this is no government policy. We need to put together, the 10 corporations here need to put together a venture fund. And we're going to do it. And we're all looking at one another, and we're all going to do it. And they were able to create that kind of fund. Now, there aren't a lot of geographic regions that can do that because you need a couple of real anchor corporations. But Michigan was able to do that. Cincinnati's doing the same thing now. They have a couple of anchor major corporations that they are going to say, we're going to put X amount of dollars into this thing, and we're not going to control it. This is going to be a separate entity, and hopefully we'll see a return at the end of the day, but that's not what it's all about. I think Connecticut actually has the ability to do that with the number of corporations that are headquartered here. And can you bring in the governor and basically have him in the room as well, pointing, saying, you are going to do this? Yeah, but I think that has been a very successful program.
New York
Without government intervention, and something that you are going to see dividends at the end of the day. You can't underestimate the importance of a person like Mayor Bloomberg. I mean, the guy, he's been able to transform that city simply because of who he is. and once again, politics aside, he's been able to say, this is something I want to do, I understand this, and I have enough money that I don't give a damn what other people think about what I'm doing. And he's been able, I mean, the idea that he was able to, bring Stanford and Cornell and all of this stuff in, and have excitement that you have not been able to see anywhere else. Now, the question there is, he's created, what happens when Bloomberg leaves? And rents start going up in Midtown and Park Slope, and, I think there's some issues there from, these companies are great right now, but they're also, I think, teetering. So I personally wouldn't go out and yell about New York being a success story yet. I'll give it a couple more years. And I hope it is, and I think that they've done incredible things thus far. But that's different than, let's say, San Francisco, where they've been able to basically convince a lot of Silicon Valley companies, 20-year-olds do not want to live in San Bruno. They want to live in the city. And you have seen a very effective program of creating companies in San Francisco for San Franciscans. And certainly, the cultural facilities and all the other things that San Francisco has to offer certainly has helped in that regard. When you look at state programs, one of the original programs in the country is the Ben Franklin Partnership in Pennsylvania, created in 1978 by Governor Thornburg, a Republican. Pennsylvania politics is unusual in that every 8 years since 1970, since they had a two-term governor, it changes every 8 years. Parties change. It goes from Republican to Democrat. That's a lot of years, and yet that program has never changed. I mean, they always kept it. Has the funding changed? Yes, but they always kept that program. So there has been a continuity in that program that is simply not seen anywhere else in the country. And that certainly has helped create companies in that state over the long term. Has that program, some people, here is a smaller state, but do you really want things in Pennsylvania? It gets political, do things go to Williamsport, Pennsylvania, or do they go to Philadelphia? That's an issue, but that has been a good program simply because of the continuity of that program year after year. The state of Maryland, I think, has been very aggressive in early stage investing. When you look at TEDCO, they've invested a lot of dollars in early stage companies, and I think they have the understanding that a lot of those companies are going to fail, which is also very important. Politicians, and this isn't a negative, they have a 2 or 4 year perspective, maybe a 6, depending on what their term in office is. That's how they think. And when you're telling them that you're not going to see a return for 10 years, they are like, this is not. And so that's a major education process with them. So those are things that I think are important. Certainly when you look at Research Triangle Park, the idea that the competitive universities were able to get together as a group and say, for the region as a whole, it is imperative that we work together. And they were able to take the egos aside and say, we are going to do this, and we are going to work with the state governments, a huge number of different state governments in that Research Triangle Park area, and they were able to work with the companies that were based down there. Now that was a 20+ year effort, but it has paid off. Off the top of my head, those are some.
That's helpful.
Yes.
I'm wondering if you could comment on the dynamics of the life science industry going forward. I've been in the industry for over 10 years, most of that in startups, and I've seen VCs kind of shifting their way they approach the business. Right now, we're getting a lot of conflicting signals. You already mentioned that VCs no longer want to invest in Me Too type of products. Everybody wants to see new enabling technology. And typically, such technologies require a lot of capital investments. They require a long-term horizon for the company, and yet it's not what VCs typically want to see, especially, and that's also kind of tied into the regulatory environment that we see in most recent years. So, how do you see this conflict going forward? Would that be a really showstopper for a lot of interesting medical technologies going forward?
Yeah, I think that, you certainly have seen the sharp turndown in first-time financing. At the same rate, like I said, I'm actually bullish on life sciences long-term, because I think that with healthcare reform, you're going to see a whole new market. I think that more and more life science companies are looking outside the United States for approval. Certainly, the markets outside of the United States are there today that weren't there just 15 years ago. So there are absolutely solid reasons to be investing and to be optimistic about life sciences, but you have to convince our investors of that, and that's a very hard thing to do today. There are many who say, do not be in this industry. As much as I know that this is going to help humankind, I need a return in 5 to 7 years. And that's the balancing act that we're going through right now. Yes?
You gave some terrific examples of Pennsylvania, Maryland, Research Triangle, Michigan, New York City, Ohio. To put all those together and find and identify what made them work, how could we apply that to together?
Well, I think first of all, it's leadership. It's someone who understands that this is not a short-term. There's no short-term solutions here. I think that's a huge part of it. I think realistic expectations is very important. Understanding that there is going to be more failures than successes, and that's a real issue today. Because one of my biggest concerns about basic R&D in this country is that you have one party who's saying, if I give you R&D and that money doesn't actually create something, you have quote unquote wasted taxpayer dollars. That's a very scary scenario, and I think that's where we are today. And you're going to and folks want to see a return on basic R&D tomorrow. And that's a concern. And that education process, that failure is an integral part of this, is very, very important. And it's becoming more and more difficult to sell that today. And you can't blame a politician when they're saying, do I fund Women in Crisis program, or do I fund this basic R&D? I know I might get something over here. I have no idea what I'm going to get over here. That's a hard thing. That's a hard thing for a politician to, for us to say, fund the R&D. But it's something we have to do for the good of frankly, of mankind over the next couple of generations. So, understanding the longevity and the huge amount of failure and risk here is important. The other thing, and this is a controversial remark. I personally believe that I have this metaphor. Entrepreneurs are like cupcakes. Cupcakes have always been around. Cupcakes have been really hot for the last 5 years. You go to stores, cupcake, fast food, there are TV shows about cupcakes right now. But something's taken over cupcakes, if you notice. Donuts, you look around, donuts are the hot thing now. You're going to start seeing donut shops, you see people talking about donuts. To me, donuts equals manufacturing. I think you're going to see more and more policymakers saying, we've been talking about entrepreneurship for 10 years. Look at the employment numbers. What have you done to change these employment numbers? You entrepreneurs all say you create jobs. Oh, you create jobs, but you create jobs for the top 2%. You don't create mass amounts of jobs. What we care about as politicians is how do we impact that other 90+%. And manufacturing is the answer in there. I'm not saying that's right, but I'm saying that's how they're starting to think. And you're seeing more and more, you open up a paper, you read op-eds, you see more and more stuff about manufacturing. How do we bring these plants back from overseas? How do we create manufacturing in the United States? And I think that people will always love cupcakes, they'll always love entrepreneurs, but are we going to be the pinnacle that we have been for the last 5, 10 years? I don't think so. And we have to be very aware of that. Like I said, that's a controversial remark and people could debate that all day long, but that's how I see it right now. I think that idea of the entrepreneur is sacrosanct, that idea is starting to get a bit shaky in Washington.
So segueing a little bit off that, can you speak to the growth in the foreign investment in funding? I think it started at like 5% when you first got into the industry. It's up around 25% now.
Yeah, about 25% of our dollars that we raise come from overseas. And that's important to note because from a different number of different areas. Most of our money comes from colleges, endowments, pension funds. And we used to be able to very easily raise that money within the United States. Over the last several years, as many pension funds move from defined benefit to defined contribution plans, we can't take that money. It's not like if you have a 401k plan, there isn't a box that says venture capital. You know, it's a Fidelity Growth Fund or Vanguard small company stock, but there isn't venture capital. So that movement has basically taken away a lot of our dollars. There's only a finite number of colleges and universities, endowments, family offices I think have become much more important over the last several years and will continue to become more important. But you're also seeing a much more sophisticated group of investors overseas. They started out saying, I want to be in venture capital, and they started in Europe, and it's been a disaster. So they say, if we're going to do venture, we want to do it in the United States. And so you've seen, and Asia as well, Asian investors as well. So you are seeing an absolute increase in the amount of money coming from overseas, and I think that will continue. The public policy perspective of that is that if we have good returns, you know, from a public policy angle, do you want that going to U.S. pension holders, U.S. colleges and universities, or do you want to see that money going back overseas? And you can see some politicians saying, why is that? Why are all those profits leaving the United States and going somewhere else? So hopefully that's a good problem to have. Hopefully we'll have that problem, but it's we haven't had it over the last several years. Yes.
If you could comment, venture is only as good as its ability to fund innovation. And innovation, you can trace Silicon Valley back to Fairchild.
Absolutely.
Swanson took Boyer patent, who started bioscience, in 73. Internet is 20 years old. I'm wondering if the lack of, or the regression in the number of VC firms is due in some part to a big innovation funding a big set of industrial companies. If you could comment on whether there's something to that.
I think it has more to do with where venture capitalists are comfortable in investing. When you look at the whole clean tech arena, it never surprised me that venture capitalists got into the clean tech arena originally in 2 areas. In solar, because venture capitalists understand chips, so they understand that money. And in the biotech space, because they understood bioremediation deals, and they understood that space. So they naturally will be attracted to areas that they already know from not from a business perspective, but from a scientific technology perspective. I think that has artificially restricted the ability of this industry to grow. You need to bring in my view, not just more different technologies. You know, you're starting to see more deals being done in the education space, in the financial services space, in space itself. And I think that those areas, as we become smarter, will grow. I also think this has been largely a middle a middle-aged, white, male-dominated industry. Not a little, a lot. And I think the idea of bringing in folks other than 40-year-old men would certainly help this industry, because they will look at things at a very different perspective. So those are two, I think, major reasons. I think innovation is there, always will be there. It may not all be the province of the United States anymore. I think it's great that you're seeing venture ecosystems in other parts of the world. But I do think we restrict ourselves by our knowledge.
I think we have time for just one more question if we have. No?
That's it.
We're good. Excellent.
Thank you so much,
All right.
Jackie.
Thank you. So, having Mark here with us today is one of many steps that we've taken on our road to really being kind of a premier leader in southern New England in the VC group space, not just in Connecticut. And so to have a national leader like this is really exceptional, and we're thrilled that you could all join us today. And I'd like to just introduce as our last speaker of the evening, Liddy Carter, who has really been critical in making this all happen and take our organization to another level.
And thank you all for being here. I'm so happy to see Mark. Mark and I worked together when I was working more in the angel community, and he was a real inspiration to that group, the Angel Capital Association, because the National Venture Capital Association has been so instrumental on public policy issues. And as the distinctions between angels and venture and private equity have blurred over the years, his leadership on the public policy front is really helping all of us figure out how to push all these industries forward as a group to provide funding to all of you. So I can't thank you enough, Mark, for not only being here, but all the work you do and will continue to do, despite the fact that you think you're going to be taking a little time off. We know that's not true. So that's good. I'm not sure how to move this, Jackie, or someone. The other thing I'd like to encourage all of you to do is to understand that we have huge opportunities here in Connecticut to become a very vital, to continue to grow, to be a very vital community. We have not only sectors that are quite unique and that Mark actually talked about. One of them is advanced manufacturing, for instance, as well as life sciences. And those are two areas that Mark highlighted as real opportunities for us going down the road. Another is financial services. There's actually, we are a focal point for financial services in the venture capital world, not surprising given the activities in Fairfield County and drafting off of New York and all the hedge funds that are there. So we have some areas of distinct, unique, and clear strength here in Connecticut. What we do at the Crossroads Venture Group is to try and highlight those on a monthly basis, the second Thursday of every month. I know you've all heard me say that before, but let me just ask you to please continue to come to our events. We have several events coming up, and we also have a boardroom series where we can provide in very small groups, 10 to 12 people, specific topics. Go to our website, you can always see what's coming up, and I don't suspect any of you have failed to get invitations from us. Coming up in Hartford in particular, since most of you are from this region, is an event in October. It's a little soon to be talking about that, but that will be about advanced manufacturing, and then again in January 2014. We have those are the next two Hartford events coming up. We have some regional events coming up in July in New Haven, something for early stage companies, Grow with the Grove. And in October, summer networking in Stamford, right in my office building. Please come. It'll be a great party in August. Also, we want you to think about why we're here and how we're here. We're here because of our sponsors. Thank you all who are sponsors here with us tonight. You can see we have a lot of support locally. The reason these guys are supporting us is because they're part of this community. I'd encourage all of you to join CVG. It's easy to do. We have different tiers of membership, and participate with these sponsors, get to know them. As you're growing your businesses, it's a lot easier to do it if you have a trusted group
of people who know what they're doing. This is a very specialized area. It's not every lawyer, it's not your brother-in-law necessarily who knows how to do this. So join us, we'll tell you who's who and what's what and how to get your companies growing. So we really want to thank you for coming tonight. There's drinks, there's hors d'oeuvres out front. Please talk, mingle. There are a lot of companies to see. Thank you again for being here, and we'll look forward to seeing you soon. Thank you.